Oh, okay. So we are recording, and welcome everyone. Let's take a quick moment and talk about logistics for the next couple of weeks on webinars and things like that. As we were just discussing, I am going to be moving to around Alpharetta, Georgia for a job within the next month. So I'm going to apologize in advance. We may have to move the webinars to different dates. We will still have them, I promise you that. They may just be either early in advance or something like that, but we will have a webinar for each and every module. And if just one person can attend, that's fine. You know, as long as I have one other person, I can record the webinar and it'll be fine. Okay, so next week is Easter, and I don't want to have a webinar on a holiday that I'm sure a lot of people are going to be busy. So let's do the webinar on Saturday afternoon, if that's all right. Hopefully some people can make that one. I will start it. If it doesn't work out, then we will do the webinar, let's say Monday night, as a backup plan. But let's try to do it Saturday afternoon so that we can get it out ahead for everyone, and you know, you guys can watch the webinar and be able to get your homework done and turned in on time. So we're going to plan Saturday afternoon at 2 o'clock Central for next week's webinar, and I will put out an announcement about that. The following weekend may be the weekend that we are moving. It depends on if this house is not already taken that we've applied to get, which I won't know until this week about that. So just be aware of that, and I will let you know as soon as I know, and we'll set out a schedule to figure out what we're going to do with that webinar. Okay, so I'll do my best to keep out ahead of it for you guys and make sure that we have a webinar in time for everybody to get their homework finished. Okay? So, with that said, let's go ahead and talk about chapters 4 and 5, which are your Module 3 chapters for this week, this upcoming week. You see here that basically Chapter 4 is going to be covering relevant costs and benefits for decision making. It talks a lot about Uber, a very good company, which I do use, and never had a bad experience with it. I don't know if anybody else has, but good case study there that you might want to read. This chapter is going to talk a lot about the different kinds of costs, like relevant costs, irrelevant costs, sunk costs, things like that, and then differential cost analytics, and applying that analysis and the use of limited resource. So the single constraints, multiple constraints, theory of constraints, you need to know all of that. I have gone ahead and put out the study guide for the quiz for Module 3 already, and I will tell you that you need to know the definitions of irrelevant costs, relevant costs, sunk costs, and opportunity costs. Okay? You'll see that's the very first question. It combines, I have combined like 3 or 4 questions into that one. So there are definition questions on the quiz about those. It asks about differential analysis and what it is. It asks, you know, what types. You need to be able to identify the different types of costs. So what I mean when I say that is you need to be able to take a situation that it gives you and tell what type of cost that is. Is it a relevant cost, an irrelevant cost? Is it a sunk cost? You know, what type of cost is it? So that'll be one of the questions on the quiz, and then we'll continue to go down through some of that. So just taking a look, here's the definition of relevant costs. You need to know that. Oh, yeah, it would help if you're able to see my screen, huh? Sorry, guys. Can you see it now? Okay. All right. So just know the various types of costs. This is what I was talking about here. The relevant costs, here's the definition right here. Okay. And then distinguishing relevant costs from irrelevant costs. They do not differ among competing decision alternatives. Okay. So you need to know those things. Then we come down. It's going to kind of go through some examples, okay, and show you some various things. You need to read through this, okay. Then it talks about relevance for future revenues. Cost reduction proposal is not addressed on the quiz. I will tell you that. But you still need to know it because it could come up on the midterm. Here's outlay costs. It tells you what those are. You do need to know that. Here are sunk costs. You need to know this definition. Okay? This one is definitely on the quiz. Alright. Let's see. You need to understand what sunk costs do. They can cause ethical dilemmas. Okay? It's basically the possibility of recording accounting loss can create an ethical dilemma for managers, and I've seen this happen. Although the action could be desirable from the long run point of view of the organization, in the short run it may result in a loss, and it's very hard for managers to justify putting losses on any kind of financial statement because then they have to explain it and explain why. Obviously the goal of any business is to make money, and you don't want to show a loss. Okay, so this talks about disposal and salvage values. You need to know that. And here is opportunity cost. Okay, this is also discussed on the quiz. So you need to know opportunity costs. Okay. This is any benefit that's foregone as a result of rejecting one opportunity in favor of another opportunity. There is typically a cost associated with that. So you have to be able to evaluate and determine which one is the better alternative. And then if that's the case, what are you losing, by not taking the other opportunity, right? So this kind of talks, this little summary right here kind of shows you the relevant and irrelevant costs that were discussed, okay, and gives you the definition. So this is a really good little table right here for you to work with and study, okay. Then we're going to come down here, and you've got the differential cost analysis. This is quizzed, okay. So really get familiar with this. You can see that, move this over here. You can see that the differential cost analysis is preferred to a complete analysis of all costs for a number of reasons. It gives you these reasons right here. I'll let you read those, okay? So you need to know that. Then this kind of shows you the actual differential analysis. Now, this is something that you need to be able to do. You can see here, it's basically talking about, the conversion of an old machine to a new machine. If you replace with the new, you're going to pay out $160,000 for the new machine. If you keep the old machine, you're probably going to pay $200,000 to maintain it. So your difference, the effective replacement on income, is $40,000. Okay. Inspection and adjustment, you can see the differences. Machine maintenance, you can see there's a large difference right here between the old machine and the new machine. And you get the disposal, which means you're selling or getting rid of that old machine, and you're paying for the new one. So this is how you analyze whether or not you want to buy a new machine. Okay, you're basically taking a situation, that's all you're doing, and determining whether or not you want to buy that new machine. So the advantage of replacement is you would actually gain, based on this analysis, $17,800 by replacing that old machine. So this is something that you're going to need to be able to do. Okay? This is a differential analysis. There will be a problem on that. Alright? Alright, so that's the mid-chapter review. Let's go on down. So, multiple changes in profit plans. This is just showing you how to deal with the multiple changes that come along in any organization, okay, especially manufacturing. So it's got the various variable costs, fixed costs per month that it's discussing. You see here you've got direct materials and labor, you've got manufacturing overhead, okay, and then you've got your selling and administrative and your totals, okay. So these are the various costs that you're associated with. This little symbol is euros, okay, so that's why it's for whatever reason in euro in this chapter. So gives you the various alternatives. So this is just basically walking you down through, I would read this, walking you down through the alternatives. This is what cost accountants do. They evaluate alternatives to see which one is going to benefit the organization the most in terms of profit. Okay, so you can see here the increase in monthly profit from alternative 2. There's a decrease in monthly profit in 2. I'm sorry, that was in 3. And there's an increase in alternative 1. So based on that, if it were me, I would take alternative 1 because I'm going to make the most money, right? So just some things to look at. Then this shows you how to deal with special orders, and I believe there is a problem to deal something with special, or it talks about special orders on the quiz. So I would look at this as well. Okay, and then it's taking you down through and showing you how to do, again, that contribution income statement. Okay, get familiar with this because you're going to have to do this probably throughout. Okay, so here on the contribution income statement, you've got your sales, right, or your revenue, whatever they decide to call it. Don't get that confused. Some will call it revenue, some will call it sales. Some may call it, you know, something else, but revenue and sales are the two that I see the most. Okay, same thing, different word. Less variable costs. So you've got your direct materials and labor, your manufacturing overhead, and your selling and administrative. So these are your costs. You notice your sales over here, costs over here. This is the 60,000 is the total of these. You're going to subtract. That leads to your contribution margin. So it's just sales minus variable costs equal your contribution margin. Okay? Then you take out your fixed costs. So here's your 2 fixed costs. That's what this totals right here. You subtract that out. You still have a $5,000 profit. Okay? So that's how we're taking this contribution income statement and putting it together. All right? So, importance of time span and opportunity costs. You have to look at that. You know, what is it costing you to do a project over the course of time, right? And what are the opportunity costs within that? So, like for instance, you could consider over the course of time, prices may increase, so your costs might increase, okay? Over the course of time, you may be losing out on sales that you could be making if you were able to speed it up. Okay, so these are opportunity costs. Alright, so let's keep on going down. You've got qualitative considerations. Okay, let's talk about qualitative and quantitative. This is something that you should be very familiar with in your bachelor degree, in any degree, especially if some of you are going on for graduate degrees. You'll have to learn the difference between qualitative and quantitative. So qualitative is kind of just a way to say, let's measure this based on, what management wants to look at, what their concerns are, okay? It's kind of almost a way of saying this is someone else's opinion, so to speak, okay? Quantitative gives you hardcore numbers, okay? Quantitative research, quantitative methodology is going to measure the differences between numbers, definitive numbers. Qualitative measures the differences and takes a look at differences of opinion, differences in process, things like that. So quantitative numbers, qualitative is, more other factors. All right? So outsourcing decisions, do you make or buy it? Right? Companies face this all the time. So they have to look at what it would cost them to make it, or what does it cost them to buy it from somebody else who makes it. Right? So take a look at that. Differential analysis of make or buy decisions. So here's how that comes into play. You're going to take the cost of buying it. So this is the cost of it times 60,000 units. So by buying it, it's 120,000. If you make it, you've got your direct materials, direct labor, overhead, variable overhead, fixed manufacturing overhead, and that's giving you your total. So you've got the cost to buy is 120, the cost to make is 110. The advantage of making it is you save $10,000. Okay? Something to think about. Maybe not material, in this context, $10,000 may not be that much to an organization, but in some it is. Put another 0 on that, or another 2 zeros on that, then I'd say I'd be making it. Okay? Differential analysis of make or buy decision with opportunity to rent facilities. Okay, so then that takes this and puts the rental side of it into the mix as well, and you can see that they don't save any money making it. It's actually better to buy it. Okay? So it's important to include everything in on these decisions. Alright, so sell or process further, right? So do you sell it after a certain point, or do you keep processing it, right? So basically this is taking a look like at a furniture company that maybe doesn't paint or finish the furniture that they make. So they have to take a look at, do we finish it, or do we sell it and then let somebody else finish it somewhere else? Okay, so that's the decision that they're looking at there. So you see where this chapter is going. It's all about making decisions based on the costs and the potential profits or the potential losses. That's all this entire chapter is doing. Okay, so don't get hung up on the terminology. It's pretty much simple addition, subtraction, multiplication, division type stuff. And you just have to know the components that are going into each one of these. This talks about joint product decisions, split-off points. Okay? So joint products are basically 2 or more products simultaneously produced by a single process from a common set of inputs. Those are called joint products. Okay? You can do this in things like dairy, chemical, meat, petroleum, and wood products. Okay? So those are considered joint products. Those are good examples of joint products. You've got a split-off point. Okay? That's the point in the process where the joint products become separately identifiable. Okay? That's called the split-off point. All right. Notice here, joint costs are irrelevant to a decision to sell a joint product or to process it further. Okay, that's important to know. You might want to highlight that. Okay, talks about limited resource. And here's where we get into the singles constraint analysis, and you'll then see multiple constraints as well. So this talks about achieving short-run profit maximization. A for-profit organization should allocate limited resources in a manner that maximizes the contribution per unit of the limited resource. I would know that. All right. Basically, this is just information for the 3 service packages that are talked about in this example, and it shows each product, right? So that's the selling price, that's the variable cost, and that's the contribution margin. Then that shows you the hours per unit. Okay. Then you're going to get the contribution margin per hour. That's how you calculate that. Okay, just by taking this contribution margin and dividing it by the hours per unit. Okay, and that's giving you your contribution per hour. All right. Then you come down here. Again, this is all a step-by-step process. So just like in the last chapter when we were able to come down here and get this part of the problem and work our way back up to this, right? So you need to be able to work it forward and backward. That means you've got to know, what is, if the problem gives me this right here, how do I get down to this? And vice versa, you need to know if the problem gives me this down here, how do I get back up to this, right? So make sure that when you're taking a look at these, you can see how you could work it forward and backward, okay? Because you never know what they're going to give you in the problems. This talks about multiple constraints. So it's basically saying assume a second constraint, that is that the maximum weekly demand for C is 90 units, although the company is capable of producing 120 units. Okay, so this is showing multiple constraints. All right. And then this talks about the theory of constraints. You really need to know this. It is quizzed. Okay? It states that every process has a bottleneck or a constraining resource, and that production cannot take place faster than it is processed through that bottleneck. So that's the theory of constraints. The goal of the theory of constraints is to maximize throughput, which is defined as sales revenue minus direct material cost. So know that throughput is sales revenue minus direct materials cost. You will need to know that. You will need to know that the goal of the theory of constraints is to maximize throughput. That is a question. Okay? All right, so here's what the implications are. You need to know these implications as well. Management should identify the bottleneck, schedule production to maximize efficient use of the bottleneck resource, schedule production to avoid buildup of inventory, and work to eliminate that bottleneck. Okay? So we know in management, anytime that we go into a situation, we know there are going to be problems. It's a given. Sometimes we're able to identify those problems up front. Sometimes we're not. Sometimes they just happen. So one of the things that you need to realize in any business organization, whether you're in management or whether you're in accounting and finance, you have to realize that there are always going to be problems, and you need to try to anticipate those problems where you can, but you also need to be flexible enough and adaptable enough to navigate the problems when they do happen, whether you were able to foresee them coming or not. Okay? So just understand that that is a huge part of being a good manager in any company. Okay? And even if you aren't the manager, you have to be flexible enough to maneuver problems as they arise. That's what leads to an organization's success. The global economic environment changes constantly. If you're not able to maneuver those, then your organization, especially if there's a lot of you that aren't able to get through that, your organization's likely not going to succeed. So change is constant. You have to be able to do it. You cannot open a business or run a business these days expecting everything to remain the same forever. It doesn't happen. It's an unrealistic expectation. Okay? So understand these very well and be able to apply them. Okay? So to support the theory of constraints, performance report should do these things. Measure the utilization of bottleneck resources, factory throughput, do not encourage the full utilization of non-bottleneck resources, and discourage the buildup of excess inventory. So this is one thing that you will see in any business, is being able to measure your inventory. You don't want to keep a whole lot of excess inventory because, as with everything, just like we said, environments are changing. Some things go bad. Some things become less valuable. People have proven throughout time that they like the latest and greatest model, technology, things like that. So if you're building up inventory that's sitting there and you're not able to get rid of it, that inventory loses value as it's sitting in your warehouse. So you don't want to build up the excess inventory. And you can apply this to any business that sells anything. Okay? All right, so let's see. So that's the end of this chapter. Let's take a look at the problems. Okay. So the first problem in chapter 4 that you're going to have to do is E422. So here we go. All right. So this problem is asking you, should HP outsource this component from Samina SCI? Support your answer with relevant cost calculations. So what you're going to do with this is that's the right problem. Okay. So what you're going to do with this is you're going to pull this up in a new Excel spreadsheet. And we're going to take a look at this. All right. So E422, right? So if we're going to evaluate this, we have to decide whether or not we want to make this, right? So we're going to evaluate the cost to make the product, right? In order to do that, we've got to take a look at our variable costs. We got to take a look at our fixed costs. Okay. We've got to take a look at our rent income, which is an opportunity cost. Okay. And we've got to take a look at then the cost to buy. So if we decide we're not going to make it, we got to figure out what it's going to cost us to buy this, okay? And then the advantage, subtract those two out and get the advantage to or disadvantage of buying. Right? And then you're going to tell me which one is better. Okay? So if making it has an advantage, you would say making it has the advantage and how much. Or buying it has the advantage and buying it has an advantage by how much. So in this problem, let's do this. All right. So in this problem, it tells you what your variable costs are, or how many units you've got. So you're going to figure this out. So it has 10,000 circuit boards per year, right? So that's how many that you need to produce. Then you need to figure out what is the variable cost and what is the fixed cost, correct? So in this case, the variable costs it tells you are $24, right? So you'd multiply that by 24. Gives you your variable cost, okay? Then your fixed costs, again, you've got 10,000 units, and you've got to figure out your fixed cost. So it tells you down in the problem that your per unit is $5. That's the fixed overhead, right? So equal sign 10,000 times 5 gives you $50,000. You also need to take a look at the rent income. So Hewlett-Packard accepts this offer. The facilities currently used to make the boards could be rented to one of Hewlett-Packard's suppliers for $27,000 per year. So that $27,000, you don't need to do anything to that. You just it's just calculated. All right. So this is the cost to make it. So what you're going to do is add these three together, right? And that is going to be your cost to make it. All right? Your cost to buy. It tells you in the problem that if you were going to buy it, the cost is around $34 per board, okay? And that gives you your total on that. So you're going to take your 10,000 times your $34 per board. That gives you 340,000. Let's just move this over here. Okay. Then you're going to, and that is actually going to be a negative, because you would have to add these two together, right? So here, you're just going to do this plus this, and you get a negative 23,000. Okay, so this is the advantage or disadvantage, which I spelled wrong, sorry, of buying. And you notice that a disadvantage is a negative, right? So what would you say this is? Does it have, which has the advantage? First of all, which one has the advantage? Making or buying? You guys still with me? Anyone? Okay. Alright, so the advantage on this one is making, right? Because you're looking at a disadvantage of buying, because it's going to cost you more, right? How do I get the negative 340? So the cost to buy, you actually have to take the 10,000 units times the $34 per board. So you see here where it says it has a cost of $34 per board. That's where I got the negative. Okay, so you have to pay them. If you're going to buy it, you have to pay somebody else to buy it, right? Does that make sense, Brandy? Okay. So I just put it as a negative because I'm paying them $34 as opposed to me making it, where yes, it's going to cost me money to make it, but why did I not use the $8 per fixed per unit? Good question. So in this wording, you see this? Consisting of variable costs per unit of 24 and fixed costs of 8. So basically this problem is trying to trick you. I know that 24 and 8 don't add up to 34, but that you have to assume that there's going to be a markup of some kind as well. Okay? So this is where it tells you, assume that Savannah SCI offers to sell Hewlett-Packard 10,000 circuit boards for $34 each. This is just telling you what the variable and the fixed costs make up of that $34, but you have to assume that if somebody else is selling them to you, they're going to want to make a profit. So in this case, if it asks you that, you would be able to say they're making $2 per unit profit. Does that make sense? Okay, cool. All right, so you really have to read, and this is one thing that I should probably emphasize, read these problems for exactly what they say, okay? Don't try to read into them. Just read them for exactly what they say. Make sure you pay attention to the different components they're giving you, because they're trying to throw you off, okay? They want you to really fully understand this, okay? All right, so that's E422. Anybody got any questions on that one? Nope. Okay. All right, 424. So in 424, it's again asking you to conduct a make or buy analysis. Okay. So E424. So we're going to do this one a little bit differently, because this one's going to take into account relevant cost analysis. So this is essentially, this is a make or buy decision with the costs of making being the costs of office billing and the cost of buying being the cost of the billing service. Okay? So when you read down through this problem, you'll see those two differences. You're going to note that there is an opportunity cost associated with office billing. This cost is going to be based on the value of the 2 hours per week that you could otherwise be available to see patients. Okay, so basically this is a doctor's office saying, you know, do I bill or not? Okay. All right, so we're going to do it this way this time. So I'm going to put the cost to make, the cost to buy, and the difference. So this is going to be the effect of buying on income. Okay, so those are going to be our 3 columns. Expand this just a little bit. Okay, and then over here we're going to set our different components. So this is going to have, you're going to have a contract price, and then you're going to have the cost of office billing. Okay, And we're going to set this to show your weekly outlay. Alright, so this is bookkeeper. Okay. And the rent on storage space. And then you're going to have an opportunity cost as well. So, and that opportunity cost is going to be the value of Doc's time. Right? And then you're going to have a total. And then you tell me the advantage down there. Alright? So, let's go through this. So, the contract price is going to be over here in the cost to buy. Alright? In here, it tells us that the North Falls Physician Service Center has offered to take over all of his billings and collections for an annual fee of $12,000. So that's annually. Okay? We are trying to figure this out on an annual basis, what he's going to be, you know, what the cost difference is. So the cost to buy here is $12,000. And you're going to put that as a negative over here. Okay? Because, again, this is a cost to him. Right? Alright, so on the cost to make, so this is, in this case, the cost to make would be the bookkeeper, the rent on storage space, and the opportunity cost, the value of Doc's time, right? So the bookkeeper, it tells you he can hire a bookkeeper for wages and fringe benefits of $15 an hour, okay, for 50 weeks per year. So she's getting 2 weeks of vacation a year, right? So what you're going to do in that is you're going to calculate what her annual wages and benefits would be, okay? So here we go. So this is going to be 10 hours a week, right? Because it says she would work, she would have a part-time bookkeeper. Oops. I didn't want to do that. Sorry, guys. Hit the wrong button. Bear with me a minute. There we go. Alright, so he wants her to work 10 hours per week. So we're going to take 10 times $15 an hour, right, because she's making $15 an hour, times 50 weeks, and that's going to give us our annual cost, okay? So we put that formula in, tells us $7,500. Then we've got to look at the rent on storage space, okay? So where did it tell us that? So in order to store his records, he would have to pay $100 per month, okay? So rent on storage space, you're going to take, and that will be 12 times $100 per month. Alright? Now, both of these are also going to go over here in this difference, because this is where we're going to calculate which one's better. Then you got the value of Doc's time, right? So he would be able to see, it tells us that he would be able to see, he'd have 2 more hours a week, he could see 3 more patients, and over the course of 50 weeks, so he gets an average fee of $30 per visit, right? So he can see 2 more patients, or 3 more patients, and has 2 more hours a week. Okay? So we're going to do that calculation. So you're going to calculate 2 times 3 patients times $30 times, oops, hit the wrong button, times 50 weeks. So that's per week, right? So we got to get it an annual basis. So that gives us $9,000. Okay. No, Felicia, that's a good question. You don't, when you're, the cost to make, you're never going to throw a negative in front of it. Okay? So you think of the cost to make as an advantage. Okay? You're going to think of, okay, if I make this internally, typically, you would think that it's going to cost me less. Okay? So you're not going to throw that negative in front of the 7,500 and the 1,200. No. Okay? So we're also going to put this 9,000 over here in this column, right? Then you're going to total this up. And you get a $5,700 total. Okay? So, do you make or do you buy? Which one? Is there an advantage to outsourcing it? And I would also suggest that you do this. So in this total column, you're gonna take and total all of these, and it will make it a lot more clear. Okay, so the cost to buy. So this is if you had the cost to make in this case is you're hiring a bookkeeper. Right? In this case, you're outsourcing. Right? So for those two, you can either hire a bookkeeper or you can outsource it. Which one's more expensive? Anyone? Right, the making is more expensive and the outsourcing is going to be cheaper. So you can see here why Doc would outsource this billing, correct? So your answer to this would be the advantage of outsourcing is $5,700, and you'd put that down here in this area. Okay? Everybody understand that? You understand why we do these analysis? Can you also see where this is applicable in the real world of business? This is why people make the decisions that they do to outsource, right? Because they have to take a look at their labor costs and things like that, and in some areas, labor's cheaper, in others, it's not. You know, you have to consider the cost of living for people and things like that. So it's a very difficult decision to have to be put into when you decide to outsource, because you know that people are going to lose jobs in your area. But at the same time, there does come a point for many businesses that they have to find a way to save money to survive. So if they can't survive, you know, nobody's going to have a job anyway. So you have to, there's always a lot of these decisions that you have to consider, you know, when you're taking a look at whether or not to outsource or to keep it in-house. Okay? And it goes for jobs, it goes for products, it goes for everything. I know it's a very touchy subject, and believe me, I've been on the wrong end of it many times myself. But you know, it's just something that you have to deal with. All right, so let's take a look at E425. This again is just going to take a look at your costs and your advantages. Okay, So E425 is this one. Determine whether product F should be sold or processed further into product G. So this is very similar to the problem that we just did. You're basically going to take a look at your revenues. Now let me make sure I put E4-25. So you're going to take a look at your revenues. You're going to take a look at your costs. Okay, so the cost to outlay, cost of additional processing. You're going to have the opportunity cost of not selling. F. Okay? So is there an advantage? Or a disadvantage? Right? And that's going to be your total. Okay? So you guys, that one you should be able to calculate pretty easily. Alright, I'm not going to calculate that one. Then we move on to Chapter 5. So let's go on to that. Alright. So Chapter 5 is talking about product costing and job and process operations. Okay? So product costing, it's going to talk about product costs and period costs. You need to know the differences between those two. Components of your product costs. It takes a closer look at manufacturing overhead, so what all makes up manufacturing overhead, right? Then it takes a look at the production environment and job costing for products and services, okay? So you have to think about this. You've got products that are manufactured every day, but you also have services, okay? So for instance, like if you're talking about a software company, they have services such as implementation, for instance, of your new software, okay? They have support services that sometimes they charge for. Sometimes you have to pay for those, okay? So you have to, but you also have to take a look at the costs that are associated with it. So in other words, how much does it cost to have that service person sitting on the other end of the phone? What's his salary, right? And what's he doing when he's not on the phone helping customers, right? So you've got to take a look at those things. You've got process costing. So this is the cost of production report. This is weighted average, first in, first out process costing. Okay? I think you should probably remember the first in, first out, last in, first out type thing from financial accounting. Same thing here, okay? First in, first out. All right? Process costing in service organizations, how does that occur? So the chapter is going to go through and it's going to talk about all of this. You've got the various types of organizations. So you've got service organizations, you've got merchandising organizations, and you've got manufacturing organizations. Service organizations, these are some big names right here, right? You have merchandising organizations, more big names, and your manufacturing organizations, okay? You've got raw material inventories defined, work in process inventories, which are partially completed goods that are in the process of being converted to a finished product. So as each month ends, you have to be able to account for that. So you have to be able to look at what are your goods that you have that are in progress of being, manufactured. And then you've got your finished goods inventory. So this is the stuff that's sitting on the shelf waiting to be sold, right? The Manufacturing organization, this shows inventory costs at various organizations. So you've got your service, you've got the asset, so this is your supply, this is your expense, right? Merchandising inventories and supplies inventories are your asset in a merchandising organization. This is your expense. You've got your cost of goods and your supplies expense in a merchandising organization. Okay? Then you've got manufacturing. Okay? There's a lot more that's involved with manufacturing. So you can see why, and I will tell you, it's very hard to get into a manufacturing organization as a cost accountant unless you've got experience, because there's a lot that goes into it. So, just be aware of that and make sure that you understand. In a manufacturing organization, you've got an asset of all of this. Raw materials inventory, work in process, finished goods. You've got your manufacturing supplies that make up all of this right here. And then you've got your office supplies inventory as well. Over here in the expense, you've got your cost of goods sold and you've got your office supplies expense. Okay? Alright, so that's a good chart for you to know. Then it goes on to talk about product costs and period costs. Okay? Product costs are all costs incurred in the manufacturing of products. Okay? The period costs are expired costs other than those related to manufacturing inventory. Okay? And they are recognized as expenses when incurred. So here's some examples of period costs, like the president's salary, sales commissions, advertising costs, and all other non-manufacturing costs. Okay? So those are period costs. And again, this is broken down right here. You need to take a look at this chart and go through it. Okay? Know what an absorption cost is. Then it talks about the three components of product costs. So you've got direct materials, direct labor, and manufacturing overhead. This is where it really breaks it down and makes sure that you understand everything that's put into that product cost. Now keep in mind, this tells you when I'm calculating a product cost, these are the three components I have to have numbers for, right? If it doesn't give me one of those numbers, but it gives me the total product cost, I can come back and calculate what direct materials is, right? Okay, so here's how it works. You've got your direct materials, labor, and overhead, okay? It all goes into the work in process inventory. When the product is finished, it goes down to the finished goods, and you can incur your cost of goods sold, okay? So once you sell it, then you incur your cost of goods sold, right? And it also shows you over here how you account for it with your T accounts, okay? Alright, so this takes a closer look at manufacturing overhead, okay? So read through that and make sure that you understand that. Selecting a basis or cost driver for assigning overhead. This explains how that's done, okay? So, and gives you a good example. Machine hours may be used to assign manufacturing overhead costs if the number of machine hours used is believed to be the primary cause of manufacturing overhead, okay? So this is kind of up to the organization based on the way that they operate to determine this, okay? You can also use predetermined overhead rates. So this is kind of like, figuring out, based on the trend, what should our predetermined manufacturing overhead rate be, okay? So, and that's what they're going to assign it to, okay? Here's the formula for that. So it's going to take predicted manufacturing overhead cost for the year and divide it by predicted total direct labor hours for the year. Okay? So that's how you calculate that. Then you've got manufacturing overhead applied to work in process inventory. That's going to be, the formula is actual direct labor hours times the predetermined manufacturing overhead rate per direct labor hour. Okay? And then it shows you kind of how to calculate that. Okay? So those are pretty straightforward. You should be able to get that. Changing cost structures. Yeah. Then it talks about the production environment. Process manufacturing, you've got production of identical units on a continuous basis. That's basically called process manufacturing. You've also got job production or job order production, where products are manufactured in single units or in batches of identical units. Okay, it gives you some good examples of each one of these, right? Know what the bill of materials are in the operations list. And then you've got production order. You've got a job cost sheet. It tells you what that is. These are all things you should know. Okay? A materials requisition form and a work ticket, what each one of those are used for. Okay? Job costing for products and services. Okay, this is basically going to go down through and give you a cost flow affecting inventory, account, or manufacturing overhead. So this, I would go through and I would know this. Okay? Because this tells you the exact process that this goes through. Alright, this is basically taking out and charting what it tells you right here. Okay, so you got your accounts payable, you got your raw materials. This takes you through all of the T accounts and walks you through it step by step. So keep this marked so that you can refer back to it. Okay. Then it shows you how job costing really works. Alright, so here it's calculating your raw materials, right? And here you're calculating your supplies. Here you've got your work in process, and here you've got your finished goods. Okay? And you'll see here that they're giving numbers to each one of these jobs. This is very common in job costing. Okay? So they assign a number to a job and they give it. And that's the identifier that they use to then go through and track how that job is working. Alright? Here's how they calculate that. Alright, so go down through that example and make sure you understand it. Okay? So job 425, you come back up here, you can see the total cost is $58,600. So job 425, it's going to come down here and you go through all of that. So this is the raw materials, right? And then this is the manufacturing supplies. And you've got your labor hours associated with that. So this is the labor hours associated with the materials, and it's splitting all of that out, right? So this is direct labor assigned to the jobs. Indirect labor, right, is associated with that. And then you've got 420, all of your beginning balance, your current costs, so your direct materials, direct labor, and overhead, right? And that's your total. Then you've got the total cost of the job, which is pulled from right here, divided by the number of units. So this gets your unit cost, right? So this example is what you're going to refer back to when you're working your problems to see how it is that you need to calculate these out. Okay? And then this shows you the general ledger accounts and subsidiary records for inventory categories and cost of goods sold. Right? Shows you exactly how each one of these is accounted for. Okay? So you can come up here and you can see what's going on, and you can tie it all down in here. So this 46,700, it's showing you your raw materials, right? It shows you how this is calculated. So you just kind of start down here at the bottom and you work your way up to your T accounts. All right. Then you go to the statement of cost of goods manufactured. Now, this is your template right here for this particular statement. Statement of cost of goods manufactured, this is exactly how you're going to find that. Okay? So make sure you mark this. This is on page 160. Statement of cost of goods manufactured. Alright, so then they come down here and they show you how to do that. Alright, I'll let you go through that. Then you've got over-applied and under-applied overhead that it calculates. So you've got a beginning balance of 0, right? And you've got actual overhead of 100,000. You apply it, and your ending balance is 0. Okay? Gives you another scenario that does that same thing, where you actually have an ending balance. Okay? So if you have an ending balance, then you have an increase in cost of goods sold. That's something that you should probably know. Could be on a quiz. Alright, then it talks about service costing. Okay, and it goes through and shows you the difference in service costing. And you've got process costing in the next part. Here is your cost of production report. Okay? It summarizes unit and cost data for each department or process for each period. And it consists of the following sections. So if you get a problem that tells you cost of production report, that's what I want, then you have to have these sections, the summary of units in process, the equivalent units, and the total cost to be accounted for and cost per equivalent unit. You also have to account for total costs. Okay? So it's going to show you in Exhibit 5.7 how to do that. Summary of units in process, same thing. You have to have these components in that summary. So here's a cost of production report for process costing. Okay? Take a look at this, get familiar with it, use it to help you calculate your problems. You should come back and refer to these sections and try to fill them out. Okay? Some of them will require calculation. If you need to know how to calculate it, it is explained back up in prior parts of the chapter or in a prior chapter. Okay? It's something that you've done before. Equivalent units in process refers to the number of completed units that are equal in terms of production effort to a given number of partially completed units. Okay? Know this too. Here's how you calculate work in process. Right here. Alright. And then you've got the weighted average first in, first out processing costs. So the weighted average method simply spreads the combined beginning inventory cost and current manufacturing cost for materials, labor, and overhead over the units completed and those in ending inventory on an average basis. Okay? Then you've got your first in, first out method, right? So it accounts for unit costs of beginning inventory units separately from those during the current period. Okay? I would know what that does. And here we are at the end. Alright, so First problem in Chapter 5 is E521. Let's get down to that. Alright, E521. So, it's going to ask you to determine each of the following: cost of raw materials purchased, direct labor costs charged in production, and cost of goods manufactured, as well as cost of goods sold. So, to do this, you're going to first calculate your raw materials inventory. Right? And you're going to have a column called activity. You're going to have a column of given information, and you're going to have a solution. Okay? So, we're going to start out with our beginning balance. Right? You're going to add purchases. Which is then going, oops, doesn't like that. Equal sign. Why are you doing this? And then you're going to get your total available. Okay. And then you're going to subtract raw materials used. And that's going to give you your ending balance. Okay? So, in this case, the given information, $70,000, is given. We don't know this. We don't know this because we don't know the other one. And we do know that we used $400,000 in raw materials. Okay. And let's see. We know that our ending balance in raw materials is $80,000. So, do you see where it helps to go and fill this out and then you can work your way back? So basically what it's asking you to do here is to just come up with a solution. You're going to come up with, you're going to copy that one over. You're going to copy these two over. Okay? What you have to come up with is what is the answer. So how would you do that? Where do you guys think you would start to get this? If you know that you have this and you know the ending balance answer, what number can you easily get? Anybody? Can you get total available from what you got? Very good. Okay. How do you do that? How are you going to get that number? Any ideas? Well, if we know that this, right, is being subtracted out from this, and this is our final answer, could we just add these two together? So could we take 400,000 plus 80,000? to get our total available? Right? It's not quite, Felicia, I see what you did there. It's not quite adding those two together, because remember, we're subtracting out the 400,000. We have to have, this has to make sense. So you have to have more to get this 80,000, right? So if you put 120,000 in here and subtracted out 400,000, would that equal $80,000? No, right? So you have to have 480 minus the 400 to get the 80, correct? See how that works? But that's a good, I'm glad that you brought that up, because there's a lot of people that would do that. Okay? So in purchases, then can we not do the same thing? So we know that the total available is 480, and we know that we've got a 70,000 beginning inventory. Could we not take the 480 minus the 70,000 to get our purchases? Because does 410,000 and 70,000 equal 480, right? So do you see how we solved that backwards? Make sense? That one makes sense to everyone? Okay, cool. Then here's B. So in B, you're going to calculate your direct labor costs charged to production. Okay? So, first things first, we're going to take current manufacturing costs, because that's where we have to start. We have to get that, right? We know that direct materials, oops, if I type it right, are $400,000, right? We don't know what direct labor is. And we don't know then what manufacturing overhead is. Which is given to us as 60% of direct labor costs, right? So this is 60% of direct labor costs. Okay? So we don't know that one either. We do know that our total is 731,000, right? So it tells us that our total manufacturing costs charged to production during the year are $731,000. Okay? So we have to figure out a few things to get our direct labor cost. One of the first things we have to calculate is our conversion cost. Okay? To calculate conversion costs, we're going to take our 731,000 minus, and that's our total, right? Our total manufacturing cost. We're going to take that minus our direct materials cost of 400,000. Because by definition, that is our conversion cost. Okay? Then we're going to figure out what our direct labor costs are. Okay, so to do that, so here's what it looks like if you look at the formulas. Okay, conversion costs equal stop. Hang on a minute. Direct labor plus manufacturing overhead. Okay? Then you've got to look at that you have direct labor plus 0.6 indirect labor. So you're going to have what you're doing there is you're basically saying, I know direct labor is 100%, right? And the 60% of direct labor costs, you've got at the applied rate, you've got to add that. So you're going to have 1.6 is your direct labor. Okay? So now, to calculate direct labor costs, you're going to come over here, and you're going to take 331,000 divided by 1.6, because that's our formula, remember? So, here's your answer to calculate your direct labor costs. Okay? That make sense? Alright, so let's take a look. Then we've got to calculate next, we've got to calculate work in process. So again, we're going to follow that formula. Okay. So you're going to do the same basic thing in this one as what you did in A, right? So you're going to have your beginning balance, etc., etc. So in this, I'm not going to give you all the information. I want you to calculate this. Beginning balance, you're going to have add your current manufacturing costs, and then you're going to have your total costs in process. You're going to subtract your cost of goods, manufacturing, and you're going to then have your ending balance. So I want you to fill in the given information, and I want you to find the solution. Okay? In D, for your finished goods inventory, same thing. You're going to have your activity, your given solution, and your given information and your solution. Okay? So for this one, again, you start with your beginning balance. You're going to add cost of goods of manufacturing. That's going to give you your total cost of goods available for sale. Then you're going to subtract your cost of goods. Sold, and that's going to give you your ending balance. Okay, so again, you fill in the given information and work your way into the solution. Okay, everybody okay with that? All right, 522. So let's take a look at 522. It wants you to prepare a statement of cost of goods manufactured and an income statement for August 2014. So here's what you do. You come down here. And you're basically going to just do a statement of cost of goods manufactured. Okay? So to do that, you're going to take a look at the current manufacturing costs. Which will consist of cost of materials, in production. So you've got raw materials as of 8/1/14. Okay, and just stick your amount over here. So like this that it's given is $8,000. Alright, so that's as of August 1. Alright, then you've got your purchases, which gives you your total available by adding those two together. And then you've got your raw materials as of August 31st that you're going to subtract out. So this is going to be as of August 31st. Right? And you're going to subtract that out. Okay? And that's going to give you, so if you take this, you're going to take the total available minus the one next to it there, the raw materials on 8/31. Okay, you're going to put that number right there. Alright, then you've got to put in your direct labor. Okay, and that's going to go right here. Okay, so this is direct labor. And your manufacturing overhead. Again, that will go right there. And that is going to all be added up. So add those three together. Okay, so you're going to add these three right here together right here. Okay, then you're going to put in your work in process right here. Okay. Which I'm going to give you that number. That's 14,000. Alright. And and that gives you your total cost when you add work in process and your manufacturing overhead together. That gives you your total cost in process. So you're going to take that plus whatever that turns out to be. Okay? And yeah, I know it says value. But you take these two, add them together, and that's what your total cost in process is. Then you've got to subtract out your work in process. As of 8/31/14, which I will tell you is $11,000. Okay, you can see that right here. Okay, that's one of the givens. And that's going to give you your cost of goods manufactured. So you're going to take your total cost in process and add it to that 11,000, and that's going to give you your total cost of goods. Okay? So that's the first part of this. That's the statement of cost of goods manufactured. Now it wants you to do the income statement. Okay? So this is the income statement. Right? And that is pretty straightforward. You're going to have your sales. Okay? Then you're going to show your cost of goods sold, which shows finished goods inventory as of 8/1. Okay? And then you've got your cost of goods manufactured, which is just the number that we just figured out. Okay, up in the first part, that's the number that you pull down in there. Okay, and between those two, so you're going to take your sales and you're going to subtract out the finished goods to get in the cost of goods manufactured to get your total goods available for sale. Okay, so you're going to take whatever sales is, right, which is 210,000. Okay, that's a given. Then you're going to come down here and you're going to have your finished goods as of 8/1. So you take that number, 15,000. You're going to take your cost of goods manufactured, so whatever this is right here, and you're going to take sales minus this minus this. Okay? And that's going to give you your total goods available for sale. Then you've got to put in your finished goods inventory as of 8/31/14, and that is 19,000. So you're going to take that out, right? And you're going to come up with some number over here. So this is this number plus, oops, not minus, plus this number. Okay? So that gives you your finished goods inventory. Alright? Now that you've got that, you can get your gross profit. Okay? All that is adding or subtracting these two out. So you're going to take this minus this, and that's your gross profit. Okay? Then you need to remove your selling and admin expenses, right? Which it gives you is $85,000. So just take that out, and that's going to give you your net income. So you're going to take these two and add them together, and that gives you your net income. Alright? So that's E522. Does everybody understand? Okay. So, Jeanette, my advice is to go through and read the chapter at least once. I know it's a ton of info. It is, but go through and just work through these problems. It's mainly filling in the numbers. Okay. Make sure you go through and really look at those chapter examples that I showed you when I was going through them. Okay? Those examples walk you through step by step how to do the problem if you just follow it down, the columns and things like that. Look at it in different ways, trying to understand how they're coming up with those numbers. Okay? See what's added in and subtracted out and how they interact with each other. That is the best way to do this. Okay? Make sure you watch the PowerPoint. Okay? That will also, that has the voiceover on it. Make sure you watch that. Alright? We got one more problem to do. I know. This is a lot. The good news is it goes downhill from here. There's not as many problems. If you look at the syllabus, there's not nearly as many problems in the weeks going forward. And towards the end, we get more conceptual than problem-based in a lot of ways. Okay, so this is E5-30. Alright. So in E5-30, let's go down to this and take a look. Okay, E5-30, it's going to ask you to compute the cost per case under both absorption costing and variable costing. Okay, and then to compute the net income under both absorption costing and variable costing, and reconcile any differences in income and explain it. Okay? So, here we go. Alright, so basically what you're going to do in this case is you're going to have your two scenarios, absorption costing, and you're going to have variable costing. Okay, so those are your two columns. Then you just have to go in and take this information that's in this problem and put it into some format, right? So you've got direct materials. I'll help you set this up. You have direct labor, and you have variable manufacturing overhead. Now, notice three main components of costing: materials, labor, and overhead, right? Then you also have fixed manufacturing overhead. Okay? And that's going to give you your total unit cost. Okay? So, in the problem, it gives you, for absorption costing, it is going to give you your absorption and your variable side. Okay? So, basically, here's what you do. Alright? You're going to say, here's your direct materials per case, here's your direct labor per case, here's your variable manufacturing per case. Okay? Here's the sales price per case, right? And then here's your fixed selling and admin expenses, and here's your total manufacturing overhead. Here it tells you that you have 15,000 cases of jelly. Okay? So, to get this, we have to figure out what our absorption is and what our variable is. Alright? Now, direct labor, let's do the ones we know we can get easily. Our direct labor per case is given, right? That's 6. So we know that. Okay? Our variable manufacturing overhead per case is given, right? And our fixed manufacturing overhead is pretty much given in the fact that it tells you your total fixed manufacturing overhead is 45,000 and you've got 15,000 cases. So you can take and do 45. What did my computer just do? Divided by 15,000, right? And for fixed on this side, it's 0, right? Because this is variable costing. This is fixed. So we don't put anything here, right? There's nothing there to put. Alright, so now we've got that. We have to figure out our direct materials per case. Oh, it also tells us that. Sorry, I didn't see that line. So we've got $12 here. Right? So guess what we do? Add them up. This is the easy problem, right? So that's the first part of it. That's A, right? This is the way you split that out. Okay? And then you got B. It wants you to do the income statement. Okay? So you've got sales, right? You've got COGS, cost of goods sold. Is it okay if I put that in there? You're going to remember that? Cost of goods sold is COGS. That's what the industry terms it, anyway. And then you've got gross profit. Selling and admin expense. And net income. Alright, so to get those, you're going to take the sales, right, sales price per case, and you're going to, let's make sure this is right. Yep. So you literally just take what they give you, the $32 per case, times 15,000 units. There's your sales. Okay? Your cost of goods is going to be what you figured out up top. Okay? So in this, you're going to have your 15,000 units times your absorption costing of $24. That gives you the 360, and you need to make sure that this is a negative, so just stick a negative sign in front of it somewhere. Alright, then your gross profit is just going to be this. Well, plus this. Okay? Your selling and admin expenses it gives you is $10,000. That's given up here. So just put that in as a negative and add those two together. And there you go. That one's the easy problem, right? So does anybody have any questions about that? Okay. Then it also asks you to do a variable costing income statement. So this is the next part. Okay. So again, you're going to have your sales. You're going to have your variable cost of goods sold. Okay. You're going to have your contribution margin. Remember, we learned this in the last chapter. And then you're going to have your fixed expenses, which I guess it would help if I could spell that, right? Which are manufacturing overhead, and selling and admin. Oops. Let's make this make sense here. And that's going to give you your net income. Okay? So, again, easy filling this out. Alright, your variable costs of goods sold is going to be the 15,000 units. So, let's do this. Equal sign 15,000 units, negative 15,000 units, times what we figured out up here under the variable costing. Okay, so times your variable costing, right? And then that's going to give you your contribution margin by adding those two together. Okay, then you do your fixed expenses, okay, which are manufacturing overhead of 45,000. That is a given right here. Okay, and you're selling an admin, right? And that's going to then give you your net income if you take this minus that minus that. Everybody understand? Then you have to tell me in C the answer to the question. Reconcile any differences in income and explain them. So, we see there is no difference. And why is that? Don't answer that on here. Answer that on your own. Okay? So there's no difference. Why? What caused that to happen? Okay? So don't answer that. Do that one on your own. Does anybody have any questions? This is it. This is the end of chapters 4 and 5. Helpful? I know it's lots of info. I know it's lots to take in. But go back and watch watch me do the problems a couple of times if you need to. You should be able to pull the numbers. Okay? Make sure you read the chapter. Make sure you watch the PowerPoint with the voiceover. And, really pay attention to the examples in the chapter and try to follow them down. Watch this webinar over if you need to. Just keep going through it until you understand it. But I will tell you, if you keep this organized now, and you understand these problems now, that the midterm for you coming up next week, not this week, but the following one, will be a lot easier, okay? Because basically, it's just problems, okay? And on the midterm, I can't help you. So make sure you understand all of these components. Make sure you understand how to find values that are not given and be able to work these problems backwards or work back into them, okay? Everybody good? You're welcome, Brandy. No problem. You are quite welcome, Jeanette. Appreciate you guys sticking with me. I know this was a long one, but these 2 chapters are pretty critical. Okay? All right, so next Saturday at 2 o'clock, we'll have our Week 4 webinar, and I will also go over the midterm at that point and tell you what you need to know. So that is a big one to be on, and make sure you watch. Okay? Alrighty, you guys have a great week, and let me know if there's anything you need. I'm here to help. Thanks, Jeanette. You too.